Effective tax planning is a never-ending topic in corporate finance. Achieving the goals of corporate finance requires that any corporate investment be financed appropriately. Since both hurdle rate and cash flows will be affected, the financing mix can impact the valuation. Management must therefore identify the optimal mix of financing the capital structure that results in maximum value. The sources of financing will, generically, comprise some combination of debt and equity financing. Financing a project through debt results in a liability or obligation that must be serviced, thus entailing cash flow implications independent of the project's degree of success. Equity financing is less risky with respect to cash flow commitments but results in a dilution of ownership, control and earnings. The cost of equity is also typically higher than the cost of debt, and so equity financing may result in an increased hurdle rate which may offset any reduction in cash flow risk. Interest charges on loans are tax-deductible expenses, whereas dividends to shareholders are taxable. Management must also decide on the form of dividend distribution, generally as cash dividends or via share buyback. Various factors may be taken into consideration. Where shareholders must pay tax on dividends, companies may elect to retain earnings or to perform a stock buyback, in both cases increasing the value of shares outstanding. Alternatively, some companies will pay dividends from stock rather than in cash. The presence of net operating loss carry-forward has an impact on strategic tax planning. Merger and acquisition transactions are often motivated by tax considerations. A loss-making company with tax loss carry-forwards is an attractive candidate to be acquired by a company that desires a lower effective tax rate. In the majority of countries, stock-for-stock mergers and acquisitions transactions are tax-free exchanges, unlike cash-for-stock transactions. While acquiring real estate properties, tax management should take the right decision in registering these properties under the name of joint stock companies rather than under partnerships or individuals in order to save capital gain tax and registration fees if there is a possibility of selling these properties in the future. If the joint stock company shares are sold, they do not attract any tax on the profit from sale, whereas selling the property itself will result in the payment of capital gain on the sold property if any gain exists, and will require the purchaser to pay registration fees of the property in some jurisdictions, which might result in high taxes depending on the value of the property sold, and makes the deal more expensive to the buyer, hence less attractive. Hope you enjoyed our series on corporate tax planning and value creation series.